What's up? Looking a little slow in the chat, huh? Good morning. And am I live? Hello, welcome. Can you hear me? All right, so I guess I wasn't recording for a moment there. Let's try that one more time. All right, so let's take a look here at the implied volatility in the S&P 500. We have in the SPX volatilities are, if we look at the front week in the SPX, prices are lower than the VIX. So for example, if we look at the front weeks here, we can see volatilities 12, 15, 17, 18, all these numbers lower than where the VIX is right now. We did see the VIX briefly this morning go print below 20. I don't know if that was kind of an outlier or what. We can see here options prices are lower than the VIX, but not that much lower, and as we move out on the curve here, option prices are actually higher. So we'll see what happens here. There's certainly a case for the VIX to kind of collapse here, and the reason for that is just realized volatility has been much lower. Let me just illustrate that for you. I put on the screen here, I've added on the bottom realized volatility, and the way I did with that was I just went under studies, add study, I went to volatility studies, and then I selected historical volatility. And so I added down below here, and this is going to change depending on what time period we put up. If I put up, you want to do it a little bit longer than just like a day or something, because that's not going to give you a realistic. But here, this is a year volatility chart, and it's showing realized volatility is actually how much stuff actually moves around. Implied volatility is what the market is pricing for stuff to move around. That's what we just showed. These numbers here are what the prices for options are on the S&P. Realized volatility is actually what actually happened, and we are way lower than what actually happened over the last couple weeks. You can see right now showing 9 in the volatility number, and if you look back in time, we were only over 20 very briefly in the last couple months. So that talks to pressure to the downside in the VIX right here, and we can see that there's still a spread that's pretty wide between spot and the front month future. In fact, right here, it's been hovering around $1.8 over the last couple sessions, and that's where we are right now. Now remember, that spread of 1.8 has to come in by expiration. So, oh my gosh, so I was just talking for a while without broadcasting, so I'm just kind of getting my bearings again here for a second. I made a really good show that nobody saw. All right, so let's take a look. What I was talking about is I wanted to show you if you are thinking about going long volatility, there is a case to be long volatility right here, and you can see that illustrated just by looking at a chart here of the VIX. You know, we're at the lowest point that we've been in some time here, right around, it shows a low of 1951, but I'm not sure. I think that's fake. It's more like 2030 or something. But regardless, we're at the lowest point since COVID took over. You can see before COVID, we were hanging out around a 12 here, but we are still at the lowest point since COVID came. And thus, you could certainly make a case for us getting a pop here at some point soon. And the way I would play that kind of pop would be to buy some call spreads. Now, not out-of-the-money calls. Buying out-of-the-money calls in VXX or UVXY is an extremely expensive way to play a volatility move. However, buying a call spread can be a good way to go. And the reason for this is the skew, okay? In 1987, after the crash, they put a skew in a lot of the indices. So if we look at SPX options, we pull them up, we can see there is a skew. So let's go to January. And I have the last line on the outside here is implied volatility. So you can see where it says here 60-70%. Let's go to at the money. At the money is 36.66 right now. So if we go to at the money here, we can see as we move up in the calls, the implied volatility gets lower. And as we move down in the puts, volatility gets higher. Now, this is due to the fact that they kind of realized after the last big crash, or the big crash in '87, that they weren't pricing stuff right. These puts to the downside were too cheap. There was, despite all of their analysis, there was more of a likelihood of a big move to the downside than a big move to the upside, and putting a skew in kind of reflects that a little bit. Now, why is this important for us who want to be trading long volatility? Well, because there's the opposite skew in VXX and UVXY, where options to the upside have a higher implied volatility than at the money. And thus, it lines things up so that you can put a spread on that actually has some edge for you if you want to bet on an up move in VXX. So, I like to do ones that I think people call them in-out spreads, where you're buying an in-the-money option, you're selling an out-of-the-money option. And one that I would illustrate for you would be the 15-20 call vertical in VXX. Now, this is a trade if you're betting for a short-term move to the upside. This is the way to do it, I would say. So let's model this. So I'm going to buy a 15 call and sell a 20 call. Now, first of all, if we look at the price of this, $1.61. Right now, VXX is 17.16, right? So if expiration were to occur right now, this spread would be a winner, right? Because if we expired right now, this spread would be worth $2.16, right? If we add the current price of VXX to the 15 strike. Am I saying that right? All right, so how about this? If we subtract the current price of VXX, if we subtract the strike price of 15 from the current price of VXX, we get $2.16, right? So that is what the spread would be worth if we expired right now. So we're paying $1.61 for it, so we would make 50 cents on this spread if we expired right now. So having something that would be a winner if we expired right here is always a good thing. Second of all, if we model this spread in our Analyze tab, so the way I did that was I right-clicked over the trade and I selected Analyze. If we model this spread, let's say we were to put the spread on 20 times, we would actually be collecting money every day. Now, this is due to the fact that the option that we're selling is a much higher volatility level than the option we're buying. The option we're buying is like 80 vol, the option we're selling is like 100. So, if you're going to make a trade betting to the upside, it's certainly nice to have you collecting money every day while you're waiting for that to happen. That's certainly a positive. So this is the kind of trade that I put on when I'm betting on a short-term move. You can see it's a limited risk trade. You can only lose what you pay for it. And I don't keep these trades on for long periods of time. I usually would only bet to the long side for up to 48 hours at a time. But this is a way to do it where you're actually putting the odds in your favor. You're taking advantage of the skew being kind of compressed. Now, if there weren't a skew here, this would be trading for something around, let's say, $2 as opposed to $1.61. But because of the skew, you're using the skew to your advantage And we could say that the call spreads in this product are collapsed because of the skew. That would be a way to kind of describe it in trader speak. But this is the way that I get long volatility when I want to. I'd kind of rather give you folks tools to do what your ideas are than give you the actual ideas, because you're going to have to come up with your own ideas. It's just kind of the way trading works, and I know it can be frustrating, but that's just kind of the way it works. Stay tuned for the bell here coming up in just a second. I did want to go over the latest position incarnation for me, and you can see it behind me here, but essentially I bought some September puts. Basically, I'm just throwing my hands up in the air after the last trade debacle of buying way out of the money puts and then bailing out of them. So I went out to September and I bought some of the 10 puts. I paid $1.29 for them, and this is just a long-term short type play. 287 days, it's almost a year out, and I'm just buy these puts and just leave them for a while, and just kind of play the slow decay of everything. My plan is, if we do roll down for a while, then I will sell something against this. The beauty of this trade is that certainly we'll get some pops in volatility between now and September, but this gives me plenty of time for the position to come back if we get some sort of pop. So that's kind of the thought process behind that. We'll see what happens today. Yesterday, the last couple of days we haven't been moving around at all, but the VIX really hasn't come in. But it's, something's got to give here at some point. We can't have SPX option prices way higher than how much we're actually moving. People who are long SPX options are going to be kind of bleeding here, and nobody's going to want to hold on to their positions too long, and so we will see volatility come in unless we have some sort of big move one way or the other. Check out the article in the Financial Times today about why the market's rallying. It talks about just optimism about the vaccine coming. Obviously, the economy is not doing so well right now. The markets are all looking to the future. I think they're kind of making the assumption that we will get some sort of stimulus in the next couple months. It's kind of frustrating to watch the news right now and just see the president engaging in these fantasies about how he's going to somehow overturn the election results. It's like as each day goes by, that becomes less and less likely as the elections are certified, and he's lost. He's slowly losing support. He lost. Bill Barr came out this week and said that there's no evidence of election fraud, so that means he's sort of lost the Justice Department. One of his aides was sort of kicked out of the Justice Department this week, and it seems futile what the president's doing, and I don't really understand the strategy. Rudy Giuliani and his cast of characters, Sidney Powell and whatnot, are Sidney Powell's obviously out of the mainstream or the official Trump group. However, she's making the rounds of Lou Dobbs and the other conservative networks, but it really seems like there is no path. There's no real path to victory for the president at this point. What he says in the news just has not been backed up by actual filings in court. So it's kind of frustrating, wondering kind of what the point of his strategy is right now. It doesn't seem like we're going to get a stimulus package before at least the Georgia elections. I think both parties are trying to be very careful about, first of all, they want to see what happens in this election because it's going to determine sort of the balance of power in the Senate. Obviously, for me, I just wish that they'd put something through at some point. The unemployment for a lot of people is going to run out at the end of December, and the hope is that they will get that done. The markets seem to be looking farther ahead, but just as far as the normal American person, we kind of need some sort of stimulus to go through. So hopefully it does happen before that December deadline, December 31st, because that's when all of the enhanced unemployment stuff runs out. You know, a lot of people have unemployment and it says you've got X amount of weeks left, but in reality, all that stuff is just going to come to a grinding halt at the end of December. And that's unfortunate that we just haven't gotten the government to do anything about it, and it doesn't look like that's going to happen. But the market seems to be shrugging all of that off. We'll see what happens today. It looks like Moderna and Tesla down, Amazon down, but the market kind of holding up okay for the time being. We'll see what happens moving forward. All right, well, I have to go and clean because I have people coming over. It was kind of a devastating thing for this small account here, the trades from last week. So I'm just going to leave it, and we'll see what happens moving forward here. Best of luck to all of you. I don't think I've been able to salvage that interview with LaSalle and Nungo, but he has agreed to come on again to do a second one, so that will be good. And I have other stuff in the hopper as well. Best of luck for all of you, and I will see you on Monday morning, if not sooner. I'm thinking about coming on Sunday and doing a kind of Ask Me Anything where we can go over your positions with you and take a look. So that would be 6 o'clock at night on Sunday. I'll let you know on Twitter or in StockTwits if that's going to happen. Best of luck trading today, and we'll see you on Monday at least.
You're watching Famous Game on YouTube.